So let's talk about the investment itself. That's a really important section because there's a place for you to go back to your money rules and really assess how that investment is in line with your values as well as your rewards and risk tolerance. So one of the questions to ask yourself is, if you're going to provide, for example, capital to a business, how is that capital going to be used? So would it be used to repay the business's current debt, for example, or would it be used to expand into new lines of products or new lines of production? In both cases, the business will benefit. And it's a different type of investment, and it's a different type of set of values that you might be yes or not lined up with. So you really want to think about that. What if they raised only parts of the funds? Are you comfortable with being one of the few investors? And what happens if out of the, let's say, $100,000 that the business needs, they only raise 20? Does this put your investment in risk because they won't be able to raise the rest of the funds? And where would you begin to receive the funds? That also will tie in with your level of risk as well as the expected return. If you're looking in the deal with, for example, 2 years, you will not be receiving anything and then you're starting receiving payments, would you then ask for higher level of return because of that risk? And what is your projected and expected annual return? Remember, that's something that you also need to make sure that you're tracking and you're monitoring, right? We talked about that in the pitfall section. And would there be bigger returns for investors if they put larger sums of money into a deal? And do you want to consider that? Exit plan, it's another one. It's very important. Is there an exit plan? Are you comfortable with it? What happens if for whatever situation in your life you need to exit earlier? Are there going to be penalties associated with that? Or are you going to be losing an investment? This is really an important part of due diligence. And of course, that's the C word, collateral. Is there collateral? Is there security? Is there personal guarantee? Are you comfortable if there would be no collateral? And would you then expect to have a higher interest rate if you're doing, for example, a promissory note? And finally, do the risk and rewards line up for you? Not only line up from the numbers perspective, but do they also line up for you from your values perspective?
Okay, so you just heard from Renata the different aspects of the individual investment to be looking at. I'm going to talk a little bit about actually the structure that goes with an investment. So she talked a bit about, what kind of return and so forth with the investment itself. I'm going to take that investment and put it into a context of the entity or the structure of the deal. So it's really the context that surrounds the investment itself. So one of the first things to look at in this step of the due diligence process is the investment that you're considering. Is it a promissory note or is it an equity investment? Because these act very differently within a company, and they also act very differently within your portfolio, and they have different tax consequences. So a promissory note is debt, is when you are making a loan, whereas equity is an ownership share. Now, if something goes completely wrong with this company, things go south, they end up going into a bankruptcy or a restructuring or something like that, it's really important to understand that debt gets paid back first before equity holders, before ownership. And that can have a big impact both on the risk and the return. So that structure that you're stepping into is really important to understand. Now, when you're also looking at the deal structure, you want to have a really good understanding of who has control of the deal. Now, as a debt holder, you generally have very little control. However, sometimes when people make debt investments in a company and it's a large portion of their debt, you may be sitting on their board of directors and being really actively involved with the company as a debt holder. That's a possibility, and that increases your level of control or influence. But you really want to analyze who really has control of this deal so that for better or for worse, who's going to be making decisions along the way, particularly when a deal goes south. When a deal is doing great and everyone's happy, nothing to worry about. Due diligence is really a process about finding fit for you and also finding what are the possibilities, what are the possible scenarios when a deal goes south. So who has control of the deal? Next, you want to look at, of all the different types of investors in a deal, Where do you sit in that, and who gets paid when? So there are lots of possibilities here. And again, it's going to depend on the structure of the deal as well as the type of investment you're making. So if the business becomes profitable or is profitable, does everybody start sharing in that profit immediately? Or do external investors get paid back first and owners get paid back later, or managers or corporate officers get paid back later? That's one possibility. So kind of the pecking order of getting paid back is an important piece to look at in the bigger structure of the deal you're looking at. As well, are there preferred returns? Sometimes there are different types of investors and they're going to have different types of returns, different interest rates or whatnot. And you want to understand that bigger structure that your investment fits within. Now, as well, when you're making an investment in a business, they're going to have formation documents. They're going to have an operating agreement or a partnership agreement or bylaws, depending on the structure. And it's a really good idea to review that information because those documents really define the rules of the game for that entity, for that company. It defines who makes decisions, how they make decisions, how people join or leave the business. If you are considering an investment because you really have a very strong belief in one particular person who's part of the team, but within their operating agreement, that person gets kicked out by everybody else, that dramatically increases the risk for your investment because what you're believing in may leave the business. All of that is embedded in those formation documents. So it's important to read them and understand them. And they're written in legalese, I'm sorry to say, but they are. So this is another great place to get a team member to assist you. Either somebody who has a lot of direct investing experience and experiencing reading that type of verbiage, or an attorney. As well, you want to look at any specific documents to your investment. So if you're making a promissory note, read it, understand how the promissory note is written. And again, if you're struggling with that, get a mentor or a coach, a team member to help you with it. Another piece to look at in the structure of the deal, particularly when investing in a business, is what is the business structure itself? Is it a corporation? If so, it is a C corporation or an S corporation. They're very different, and how the income flows to you as an investor can be very different with tax consequences. Is it an LLC? Is it a partnership? There are a variety of different kinds of partnerships as well. Family partnerships, limited partnerships, general partnerships. We're not going to go into every single one, but you need to understand what is the structure. Is it a sole proprietorship? Are you investing through an IRA? Are you investing in an individual? So there's lots of possibilities in the entity structuring of the deal that you're investing in, regardless of the particular investment you're making. So it's important to understand what that structure is, and most importantly, how it impacts you and your money. If you have a return coming out of a partnership versus a return coming out of a corporation, it's going to impact your tax return in different ways. And again, here's a place for a team. Having a great tax strategist, above and beyond somebody who can prepare a great tax return, but really who understands tax strategy to support you in looking at the entity or the deal structure, is going to help make sure that what you're doing with your money is fitting in the bigger context of your money goals and money vision. So this step in the due diligence process of the deal structure is really looking at the greater context of your specific investment, both in the deal and how it impacts your greater context of your money plan.